Pakistan's economic condition worsens, and now it is again seeking support to repay debt. It is night. In Islamabad, the lights in a few office buildings are still on. From the outside, everything looks normal, but inside, a kind of counting is going on in which not just numbers, but the country's very breathing seems stuck. The question is not whether Pakistan has debt. The question is this: when even repaying old debt requires a new arrangement, how weak has the economy really become? That is where the fear begins. Because when a country starts looking all at once toward friendly nations, the bond market, multilateral lenders, and emergency options just to protect its reserves, then the issue stops being only about the budget and becomes about credibility. And the curiosity is this: why has Pakistan's condition once again become such that it is having to look for financial support from its closest partners? The biggest reason behind the latest pressure is the amount Pakistan has to arrange this month to meet loan obligations linked to the United Arab Emirates. Reuters reported on the 7th of April 2026 that Pakistan is facing payment pressure of around $3.5 billion, which includes the maturity of $1.3 billion in Eurobonds and other coupon obligations. That same report says this amount comes to nearly 18% of Pakistan's roughly $16.4 billion in reserves as of the 27th of March 2026. So, this is not just a repayment, but a direct blow to reserves. When the foreign exchange cushion is small and the payment is large, every decision before the government becomes difficult. Should it save the currency, manage imports, control inflation, or honor debt? The most important turn in this story is that Pakistan has, for many years, been getting such bilateral loans rolled over, meaning the old debt would be pushed ahead with more time. But this time, that easy route got stuck. According to reporting by both Reuters and Bloomberg, no agreement could be reached with the UAE on a rollover. And because of that, Islamabad is now having to speak with partners like Saudi Arabia and China about fresh support options. According to Bloomberg's report, the support amount under discussion is above $3 billion, and in some estimates even more than $3.5 billion. Put simply, Pakistan is having to look for new soil to fill an old hole. One more important thing needs to be understood here. Pakistan does have reserves, but how much of that is actually usable cushion is the more important question. According to official data from the State Bank of Pakistan, as of the 3rd of April 2026, SBP held foreign exchange reserves were around $16 billion, while total liquid foreign reserves were around $22 billion, including the reserves of commercial banks. So saying only 16 billion total reserves would not be technically correct. But it is definitely true that pressure on the sovereign side falls on those very reserves that are used for external payments, debt servicing, and currency management. And when one large payment comes due in a single month, then even numbers that look stable suddenly start to feel fragile. Pakistan's Finance Minister 𝐮𝐻𝐿 himself said on the 14th of April 2026 that for funding, all options are on the table. According to Reuters, Pakistan is considering several routes: Eurobonds, Islamic Sukuk, dollar-settled rupee-linked bonds, commercial loans, and possible talks with Saudi Arabia. At the same time, Pakistan is also preparing for its first Panda bond issuance, whose target size is said to be $250 million, and which could be supported by guarantees from the Asian Development Bank and the Asian Infrastructure Investment Bank. This sounds like strategy, but underneath it the fear is clearly visible. When a country is exploring so many financing channels at the same time, it means the pressure is real. The growing talks with Saudi Arabia are also part of this bigger pressure. Recent reports show that Pakistan and Saudi Arabia have been in fast-moving discussions over trade, investment, and broader economic cooperation. Reuters said Saudi Arabia could be part of possible financing talks, while regional reporting mentioned Saudi Finance Minister 𝐻𝐿 visit to Islamabad and meetings with top leadership. The direct meaning of this is that Pakistan wants not just diplomatic closeness, but financial breathing room too. Saudi support is not new for Pakistan. Even before this, Riyadh has provided support in difficult times through deposits, deferred oil facilities, and bilateral arrangements. But every time that support also reminds everyone of a new dependence. Pakistan's dependence on China is already deep. According to Bloomberg and related reports, Pakistan's outstanding debt to China is more than $25 billion. This figure is important because China is not just a lender, but also a strategic partner through CPK. Over the past decade, the China-Pakistan economic corridor strengthened ties between the two countries through roads, ports, power plants, and infrastructure projects, but at the same time, it also created a long chain of liabilities and repayment pressures. Analysts have long said that CPK gave Pakistan assets, but also increased obligations. Now, when Pakistan wants a Phase 2 style engagement, the tension between IMF-backed transparency demands and the need for Chinese financing grows even more. This is the most complicated truth of Pakistan's economy. It needs investment for growth, stability for investment, reserves for stability, financing for reserves, and then for financing it once again has to rely on lenders. It is a cycle the country wants to get out of, but at every turn it falls back into the same circle. Pakistan's leaders often say the economy is on a recovery path, exports are slowly improving, remittances are strong, and inflation has come down from earlier levels. Reuters reported in February 2nd, 2026, citing Pakistan's central bank chief, that the growth outlook could go up to 4.75%, which was more optimistic than the IMF's estimate. But the hope of growth and the compulsion of liquidity are running together at the same time, and that contradiction is the real identity of this crisis. The IMF is the next big character in this story. Pakistan is operating under a $7 billion IMF program, and this program is considered the anchor of its macroeconomic stability. Reuters reported on the 28th of March 2026 that a staff-level agreement had been reached between the IMF and Pakistan, through which around $1.2 billion could be unlocked, around $1 billion under the Extended Fund Facility, and around $210 million under the Resilience and Sustainability Facility. Reuters also said this could take the program's total disbursements to around $4.5 billion if the IMF Executive Board gives its approval. So there is relief, but this relief is not a full solution. It is controlled support. This is where an important nuance has to be understood. The IMF program does not give Pakistan complete freedom. It also demands discipline. A reserves floor, fiscal reforms, tax effort, energy sector changes, exchange rate flexibility. All of these are part of the program's conditions. Reuters' the 7th of April report clearly said that because of the UAE repayment, Pakistan could fall below the reserve requirement under IMF targets. Because the program wants reserves to remain above $18 billion by June, and it also relies on bilateral deposits being rolled over. This means that if bilateral friends do not extend money and IMF targets remain strict, Islamabad gets trapped in the middle. On one side is the payment deadline, and on the other side is program discipline. This double pressure is what is making Pakistan uneasy. On top of this, the global environment is also turning against it. The West Asia conflict and the rise in oil prices have increased the difficulties of import-dependent countries like Pakistan. Reuters' the 10th of April report says that the Iran war has increased import bills and inflation pressure on crisis-scarred economies, including Pakistan. When fuel costs rise, transport, power, food, and manufacturing all get affected. Pakistan has already been struggling with the burden of energy imports. In such a situation, if the stress of external debt payments combines with an oil shock, the pressure multiplies many times over. That is why the finance minister is also talking about strategic petroleum reserves. Because now the problem is not just debt, but also protection from future shocks. If we look at this crisis from the point of view of the common person, the picture becomes even clearer. On one side, the government is talking to lenders. On the other side, households feel the effects through inflation, jobs, electricity, fuel, and the value of the rupee. When reserves come under pressure, the currency market becomes nervous. When the currency becomes nervous, imports begin to feel expensive. When imports become expensive, inflation begins to lift its head again. In such a situation, even if an IMF package comes or a Saudi deposit arrives, people do not always get immediate relief. Because macro stability and household comfort are not the same thing. Pakistan's economy gets trapped again and again in this very contradiction. Headline says bailout, ground reality says tight budget. Pakistan's government argues that it has stabilized the economy over the past period. Inflation has come down from its peak, current account management has improved, remittances have stayed strong, and even the stock market has shown phases of positivity. In Reuters' the 14th of April report, Pakistan estimated remittances at $41.5 billion for this fiscal year. That is a strong number and shows that overseas Pakistanis are still acting as a lifeline for the economy. But the problem is that remittances can support the growth story, yet they alone cannot cure large external repayments and structural debt dependence. That is why, despite positive indicators, funding stress has still not ended. In this whole story, the UAE's role is interesting too. Earlier, Pakistan used to get a lot of breathing space through bilateral deposits and rollovers, but now this insistence on repayment has signaled that even friendly lenders can tighten terms. When a lender does not extend time with its old lease, the market gets a message that the borrower's risk perception is changing. This is not just one transaction. It also becomes a credibility test. If Pakistan manages to arrange new funds, then the short-term fire may be put out. But if every few months it has to look toward one lender to repay the money of another lender, then only the name of the crisis will keep changing, not the root of it. And perhaps that is Pakistan's biggest problem. It is not in collapse mode right now, but it is not in comfort mode either. It is trying to keep the IMF program on track, trying to seek support from Saudi Arabia and China, looking at bond market options, managing reserves, and at the same time the government wants to keep the growth narrative alive. But amid all this, one uncomfortable truth keeps coming back again and again. Pakistan still has not managed to stand fully firmly on its own feet. It is having to seek new funding even to repay old debt. This does not mean default is standing at the door every single time, but it certainly shows that the vulnerability is still deep. So if someone asks whether Pakistan is again begging, the factual answer would be that Pakistan is looking for emergency-style financial support, refinancing, and alternative funding. That language is more accurate, because financing diplomacy between countries is more complex than the word begging. But if you look at it from the viewer's perspective, the picture still feels the same. Once again, new doors are being knocked on in order to repay old debt. This is the point where economic weakness turns into headlines.
Right now, Pakistan is trying to get through this month through support from Saudi Arabia, China, bond markets, and the IMF. But the real question will come up again next month, next quarter, and in the next repayment cycle. And perhaps then the world will once again ask the same question. Has Pakistan merely pushed away one more crisis, or has it truly found the path towards strengthening its economy?
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.